So one of the key performance indicators that we've come up with is this idea of how to measure labor productivity. And so we've created a term that's gotten some traction in terms of the businesses we work with called LER, Labor Efficiency Ratio. As I've talked about that in other presentations, think of the idea that most people look at labor as a percent of revenue. Well, that's a pretty flawed calculation because revenue can be a very slippery thing if you have other items of cost of goods sold and those things. So we typically want to look at it from a margin standpoint and then not look at it as a percentage. We want to flip the formula around and look at the numerator being the productivity measure of gross margin and then the denominator being the measure of gross wages. And in this particular case, I want to make a particular distinction that we want to use the gross wages of that person or that group because we don't really want to load it with payroll taxes and benefits. You can certainly make the argument that those are associated with the revenue that was produced, but it makes the calculation complex and it also loses some moral high ground in terms of discussing with the employees because they don't control that cost. That's a cost of doing business for you. And so certainly the idea is if you just include it in your productivity measure, that'll be something that it becomes less of an issue and people won't push back on it. And you want to make this number for open book companies or open book management companies that like to use that technique. You want to make it available for them to where the employees can do this simple calculation themselves. And we find that they actually can do it quite easily. So let's look at an example. I'm going to show you an example of a company that's doing $450,000 of revenue per month. And they're currently at 4.4% profits because that's where they start. They have direct costs that exclude labor of $130,000, so you get to a gross margin dollars of $320,000. Now, gross margin percentage is 71%. For this illustration, I'm not going to change gross margin percentage, but I will want to make this point. I don't really care so much as what the gross margin percentage is. It's an indicator, it's something you want to look at. But I'm more interested in gross margin dollars. And here's my argument. Well, I can really hold my team accountable to maintaining a certain gross margin percentage, but try to take a percentage down to the local grocery store and buy some groceries with a percentage. You're not going to get very many. The grocery stores take dollars. And so really at the end of the day, when you think of a dynamic marketplace where margins can shift and change based on conditions, what you've got to look at is what is that net dollar of output. And if the market says that I got to give up a couple of points of margin, I got to find another way of dealing with that. Or if it's going to give me a couple of points of margin, just as well. It can go both directions. So from this example, like I said, I'm not as concerned about the percentage as I am the dollars. The direct labor cost, and this is just the gross wages of the people that we identify as direct labor. People that directly face the customer, do the things that you do. And kind of a rule of thumb is if 50% or more of your time is spent doing those activities, yet you may do some management responsibilities, I still want to consider you direct labor for this analysis purpose. And so by default, once you define who is direct labor, by default everybody else is either management or in this illustration, sales labor. So we come down to a term we call contribution margin. And as I've described before, contribution margin is probably the equivalent of what QuickBooks native P&L calls gross profit. So if you put direct labor up into the cost of goods sold section, gross profit and contribution margin are synonymous. Here's the reason why we use a different term. In the original discussion of this example, I was discussing with Vern Harnish, and so this example is actually taken out of the book Scaling Up. And so if you look at chapter 13 of this book, that is the chapter that I wrote. And so the chapter on the accounting and driving profitability, you can look at this example there, and this chart is actually the exact same one that we use in that book for that example. And so I'm kind of walking you through that idea so you can go back to the narrative as well if you want to look at the written version of this discussion. And so as we were having this discussion, we decided that gross profit was really a very weak term and a confusing term because we felt like that profit is a term that should be utilized for the bottom, the net result of the activity, rather than margin is a better term for something that is a subset of a business chain of activity. And so gross margin being the first thing that happens after you pass through direct cost and subcontracting cost, And then contribution margin is a good term for after I've then applied my direct labor, what is it that I have left over? And so we refer to this as the output of the business engine. And so of the things that you do, these are very clean, very simple, directly associated costs to the activity that I perform as a business, whether it's a product or a service or just a sales activity. So once we come down to contribution margin, then we've taken the operating expenses of the business and broken them into actually just 3 simple categories. We look at management labor, and in this illustration, I've isolated sales labor separately from management because I want to talk about that in a different way. And then we just look at all of the other expenses, so facilities, marketing, payroll taxes and benefits, and other OpEx. We just include as one line item and call it other operating expenses. I will tell you that for simplicity of high-level planning, if you actually take facilities, marketing, payroll taxes and benefits, and other operating expenses and just combine them together as one line item, it actually works pretty well as just a pure variable cost, believe it or not. And so from a standpoint, depending on how granular you want to get in your planning, what I typically find is, believe it or not, probably the more granular I get, the more errors I have. The more I stay at a higher level, I think you actually are much better at actually predicting the more likely result, in something. So from that standpoint, that's just a little trick of the trade. So in this case, we've taken management labor and then sales labor. So this particular business example would be one that is a business that either performs services or does things, but then they have a couple of sales people. That sales labor is the group of people, but your primary business is not selling things, it's selling the things that you do or you make in this example. If you were, say, a business that sold computer hardware, your direct labor would be your salespeople. Your sales labor in this example would be your VP of sales or your management labor, your sales management labor in that process. So you can see that we come down to then a pre-tax profit of $20,000. So that's at 4.4%. In this example, I'm ignoring income taxes, so let's just focus on pre-tax profit in this particular case. So based on the standards that I've talked about frequently, 5% you're on life support, 10% profit, you're a good business, 15% you're a great business. This is kind of one of those that's definitely on life support. It's not profitable where it needs to be. Now you'll also see some ratios down at the bottom of direct LER, so that 3.56 is is gross margin divided by direct labor. So 320,000 divided by 90 is 356. Sales LER, which is contribution margin divided by direct labor, you can see that that's $6.57. Management labor is 3.07, which is contribution margin over that. Now, you don't know if those are good, bad, or indifferent, from this particular standpoint. But as you start to apply this technique of fixing a business from a profitability standpoint, you'll start to see the movement in those numbers. And it is watching the movement of labor efficiency across time and data is what really gives you the intuition of what your number, your signature, efficiency ratio is going to be, whether it's direct, management, or sales. So I'm going to teach you how to be a profitability consultant. It's really simple. So we go into a business like this, and quite frankly, we say, all right, guys, here's the deal. You tell me that you think everybody's doing a good job. That's great. But at this particular juncture, if you think that you need everybody that you have, I'm going to give you one simple instruction. We need to hit $350,000 of gross margin with the same dollars of labor, all other things being equal, instead of 320. So that's it. So now you're a profitability consultant. It's really simple. Because at this particular juncture, what you have to do is give them a target that is not a revenue target, because if I give somebody a revenue target, but they start giving product away or those kind of things, my gross margin percentage is going to change. So I must set the target relative to dollar terms, not percentage terms. And so that's why I use 350 of gross margin dollars instead of using the revenue target of 492. Now I can go ahead and calculate what I think that revenue number is roughly going to be, but I really want to be driving really hard on focusing on what is the gross margin dollar number. So once we get to that number, then you can see that we get to 10% profitability. Now, keep in mind, what did I tell them? I said you have to get to 350 of gross margin with the same dollars of labor. What did I not say? I didn't say that you couldn't change people. I mean, just think you're just like a professional sports team. You know, I could let 2 people go and hire one person that's a better fit that makes the same that the 2 people I let go. I could let go one person that's really expensive and hire 2 less expensive people that are actually more functional and more directly tied into what I need. I could, let an underperformer go and hire a better performer. I could really just not change anything, and just the mere act of giving people a target to hit draws them together and allows them to produce better as a team. As I often say, a man who aims at nothing hits it with amazing accuracy. So if you really focus on that target of 350, usually that's kind of the first step, because if you really don't have a known idea of who might be underperforming in your team, once you set that hard target of what people have to hit, then you're going to flush out, where are the issues in that process. So you're leaving open the idea that labor productivity is not relative to how many bodies you have in the business. My belief is I've never seen 2 people that are worth the same amount of money, because we're all unique. We all have different skill sets. We all have different capacities of output at some times and lack of output at others. And so from that standpoint, let's celebrate the uniqueness of the human endeavor and reward it for great performance, when it does perform. And so really our philosophy around this idea of compensation is market-based wage for market-based performance. As long as those 2 things are together, people can make good money. And I think everybody wins under that scenario. So in this particular case, the team hit to that 10% level, and so everybody's typically feeling good. And I would tell you that this is the easy step in the process, because we really have not changed much other than giving people a clear target. So then the next step of the process is, well, all right, that's good. We're feeling better. And at this point, everybody's feeling energized and feeling good about, hey, we're making progress. So now you keep going and say, all right, now we got to get to 15%. We got to keep the same dollars of labor, because to be really productive in this particular industry for this business model, they need to get to 15% profit. And so in this case, same conditions apply. I can change up my team. I can let some people go, rehire some others, or I can just keep the same team and say, let's just hit this target. I will tell you that as you hit that target, so now they've got to hit 380 of gross margin, all other costs being equal. And pretty much those costs will stay equal, because really the biggest driver that changes your cost structure is the changing of labor dollars more so than changing of revenue dollars in most cases. There's a few things that drift that are relative to revenue, but really for the most part, what really drives operating costs is really the cost that you're spending in labor in most cases. And so anyway, you hit to that 15% level and you make it. Now what I will tell you is, from practical experience, is this. You will discover every weakness, every dysfunction, every challenge, every barrier that you know to mankind of getting from 10 to 15%. And just watching hundreds of businesses go through this cycle, I can tell you that this is really the uncovering of every weakness that you have in business. Now you can get there. The question is, can you stay there? Is it sustainable? And so what you learn in that process is you get to the 15% profitability. And now you do kind of what we call the baffle process. So at this particular juncture, now that I'm to 15% profitability, I'm now allowed to open up my salary cap and sprinkle in some increases in labor cost, both in direct management and sales labor, to take it to the next level. But the key, this is really essential. Now that I'm at 15% profitability, I'm only sprinkling in the additional labor cost that pushes me no further back than to 10% profit. So I'm still profitable at a minimum level of acceptability, but I'm just choosing to make a discretionary choice to add that in. And you've got to use your management wisdom of, is it more direct labor I need? Is it more management labor? Is it more sales labor that I need? So once I open up that cap and push profitability back to 10%, then I close the cap again. And now I grow back again to 15% profitability, which you can see in step 4 in that process. Now, as one of my partners once said, it's great that we always make money on the spreadsheet. I can tell you that this is actually the more reality of how most of our clients work through their issues and go from unprofitable to profitable. And then they balance between 2 data points in terms of what's my maximum profitability, which many times is unsustainable. So I've got to add labor to support it, pushes me back for a period of time. But then I can't be sloppy with that. I've got to then challenge that addition of labor spend and move back in the other direction. So one of the things I will say is when I add the labor in, understand that there's 3 ways that I add labor. I can add a body, I can give a raise, I can pay a bonus. They all count. So what we've done is we've taken labor dollars as the constant rather than bodies. And so the idea is if somebody is due a raise, well then I've got to find a way to create more productivity because of that raise. I can't just give them a raise because they want a raise. If the market says I need to give them a raise because of market pay or else they'll leave and go elsewhere, that's usually a good sign that I've got to do some pricing adjustment, from that standpoint as that labor pressure starts to go up. And so those are all the dynamics that I've got to keep all of those tools in my tool bag. But at the end of the day, I've got to really understand that for every dollar of labor that I spend, I must maintain that relevant output of that process. Now, let's study the labor efficiency ratios throughout the movement. So you can see that we started off, let's look at direct labor efficiency. So we started at 356. When we got to 10% profit, we moved to 389. And so now we've established a standard of what does direct labor look like to get to 10% profit. In my business model, we need 2 LER. I can tell you that the rest of my operating costs in my business are so knowable that if I hit a 2 direct LER, I guarantee I'll be 10% or above in profitability. And that's just a guarantee. Most business models, we can get to a number to where that is somewhat of an absolute. So in their case, 389 becomes the standard. And we say, now let's push forward. We get to 422 for 15% profitability level. Look at what happens when we open up direct labor and add the direct labor back in. It pushes it back to 386. It's within 3 cents of that target. And so you can see that that's really kind of where, as you see this movement across the continuum of profitability relative to your direct labor efficiency, you're going to be able to hone in to where is your number and where does it fit. You can even get seasonal in the case where, in our case, we know that during our busy seasons we need to be at a 2.25 LER. In our outside of busy seasons we need to be at least a 1.8. If we're above a 2.25 in busy season, it's what we call running hot. That means our people are working excessive and we got to really watch that. Outside of busy season, what you really want to watch is people working below a 1.8. That means we have work to do, but it's not getting out the door. We're not being focused in that process. So it becomes a huge management tool in terms of understanding that labor is that cost that comes to work every day with an attitude. It has a variable response rate to how well it works some days versus others. And that's really where management comes in to understand it, monitor it, and help mitigate that issue. And you can see as you get back to 15% on direct LER, it gets back to 425. So we've established within a 3 cent ratio of where that profitability levels are for a 10% and 15% performance. So now we can kind of isolate and say, well, can one cost of labor get out of line versus another? So let's look at sales labor efficiency. Starts at 657, it goes to 743 at 10%, peaks at 829, drops back to 650. Now, when we get back to 15%, notice that they're at 7.38 instead of 8.29. And so we're spending ahead a little bit on sales labor. Now, in deference to all the salespeople out there, salespeople are really good at selling you on how much they should make. That's great, but at the end of the day, I would look at this and I go, well, I'm not going to add, and once I get to step 5 in looking at adding more labor, I'm not ready to add sales labor in the next step of this process because they're not back to their optimal labor efficiency ratio. I'm going to add probably labor in either direct or management if needed. And it may be that I can start to set new standards. If you think about it like this, labor efficiency ratio across time is much like, running the 4-minute mile. It was long believed that no human could run faster than a 4-minute mile until they did. And so once Roger Bannister broke that barrier, then we've continued to move downward, and I don't even know what the number is now. I think it's like 3 minutes and 38 seconds or something like that. In terms of once you establish that a barrier has been broken, it's amazing what humans are capable of doing in terms of performance. The question is, can they consistently do it in that process? From a management LER standpoint, we go from a 307 to 347 to 387. And you can see that in step 3, it pushes us back to 338. Step 4, we're back to 384. In this particular standpoint, I'm probably looking more to add to management labor at this point to get in step 5. If I'm going to look at this, I'm going to say, well, we're probably running a little bit hot into direct labor. But if my management team is able to manage the direct labor effectively, one of the things that we started to see is as you get bigger and bigger as a business, the number that you can leverage more is management labor efficiency. Generally, direct labor efficiency is going to settle in a constant pattern. Sales labor efficiency should settle in most businesses where it's an activity sales. Now, from a sales labor standpoint, if your sales are winning a book of business and then you live off of that business for some period of time, you actually could get much more higher leverage points off of your sales labor, in that process. But management labor, you should be able to continue to leverage, because once I have a key executive, even though they might get raises in that position, it's still not going to be relative to the growth rate of that business. And so I get more and more leverage, off of that process. So as you look back at using labor efficiency as a management tool, you're going to first set it to establish what's possible. And then as you perform to that target, then you're going to use it as a tool to put costs back into the business, but not below a minimum profitability standard is our belief. Now, there's some businesses like to get aggressive and push it all the way back to 0. Certainly that's your choice, but you better have cash to fund it. Generally, what we're going to find, if you stay at 10% or better in profitability, most businesses become self-funding at that point. And so you're able to actually use your profitability to fund all of the growth that you're going to have in the business in that cycle. Now, there's going to be some businesses that might be an outlier, but in general, I would say that actually creates a self-funded growth business model that you can grow probably close to a 15% rate and still fund your business growth and possibly even take some profit distributions on top of that.